A share means ownership. When you buy a share of a company, you own a small part of that company. Simple example. Imagine a company is like a big pizza. The pizza is cut into many small slices. Each slice is called a share. If you buy one slice, you own that part of the pizza. If the pizza becomes bigger and more valuable, your slice also becomes more valuable. Why companies sell shares? Companies need money to grow. They may want to open new shops, buy machines, or hire people. Instead of taking a loan, they sell shares to the public. People buy shares and give money to the company. In return, people become part owners. What shareholders get? When you own shares, you get two main benefits. First, price growth. If the company does well, the share price goes up. You can sell your share later at a higher price. Second, dividends. Some companies share their profits with owners. This profit payment is called a dividend. What happens? If company does badly, shares do not always go up. If the company performs badly, the share price can fall. That is why shares involve risk. Where shares are bought and sold. Shares are bought and sold in a stock market. The stock market is like a big marketplace. Buyers and sellers meet and trade shares every day. Why people buy shares? People buy shares to grow their money. Over the long term, good companies usually grow. As companies grow, shares can increase in value. That is how people build wealth over time.